What are some things that we can do other than behave with integrity to maintain a clean record through all the different lenses that you typically evaluate?
One of the really big things that you can do is what you already said, behave with integrity. And the second you start taking other people's money, don't just do integrity, do transparency too.
Welcome to the Row Room Assisted Living Podcast with your hosts, Charlie Cameron and Alex Schlow. This is your go-to show for cutting-edge insights from industry leaders in residential assisted living.
Whether you're ready to launch your own assisted living business or looking to invest in this fast-growing, high-impact sector, we are here to equip you with the tools, strategies, and confidence you need to succeed.
Get ready to ride the silver tsunami and change the future of senior care.
Now on to today's show.
My name is Shane Pogue. I founded AEGIS RSI in 2024. My background is actually in criminal investigations. I fell into the financial world over time. So I joined the Army to be a part of their criminal investigation division. Started getting sick throughout boot camp and I couldn't really figure out what was wrong. I have a heart condition that activates under stress. So of course you have to get discharged for something like that. There's not a good fix to it. And I still have to deal with it to this day. But my whole life plan was to be a police officer. So that kind of threw everything out of whack. After that, I actually got experience being a private investigator for about a year before I actually went into the finance world. And that's where I learned my due diligence skills with Fidelity Investments. And when we were reviewing a lot of the private market deals and everything, I realized that it was just even niche spaces like residential assisted living. It's just it wasn't being done enough and people were getting defrauded. People were getting into business with bad partners. There was a huge amount of issues that just kept occurring and occurring. And it was crazy because it's an institutional level tool that everyone uses, but it was prohibitively expensive for most people. So all we did was bring that down to a level where people could use it on a regular basis. Specifically, I wanted to talk today about healthcare, due diligence in healthcare, because this is one of the areas where it's not done enough, because you start getting into this area where it's a highly regulated area. Whenever you go into it, you need to be very careful about how you conduct yourself, because not only is anything you do a legal risk, or in a regulatory risk, it's also a reputational risk. I've seen operators who've unfortunately lost their W-2 job after they messed up really bad in the healthcare industry because their employer found out about it and they just did not want to be associated with that person anymore. They weren't a client of mine. They were actually a subject of something, but it's a very unfortunate situation and people really need to be prepared for what the realities are in going into healthcare. A lot of the Row Room members are very familiar with this kind of situation because some of them are doctors, some of them worked in regulated areas before, so they're very understanding of, this is a highly regulated environment. We need to be very careful going forward. So one thing I always have to get across is you have to be very careful with who you partner with. You have to be very careful how you run your own operations, and you have to be very careful on how you're complying with regulatory requirements, because usually if you've operated in the assisted living space or the care home space for long enough, eventually you're going to have a state inspection. They're going to be very intense. They're going to go in, they're going to look at violations that you had no idea even existed. But if you work with them and you say, hey, this is how we plan to fix this, or most of the time they'll actually help you fix it, it turns into a completely different situation. If that keeps being a recurring issue, they become deficiencies, or you could even be fined by the state for what keeps happening. And suddenly this minor issue that could have been quickly fixed just rolls over into something major. And that's not just in healthcare, that's in pretty much every business. If you don't take care of the little stuff, the big stuff is going to start rolling on you very quickly. So actually, I can share, I have prepared one of our reports today. This one's specifically targeted at due diligence in real estate. However, it does give you a good idea of what we're looking for. And I'll skip over the parts that are specifically related to real estate. So this is one of our demo reports. If the company looks like anyone you know, or if anyone in the report looks like someone you know, they're not based on real people. The findings inside of them are based off of real things we found in the past, but they're all conglomerated together from hundreds of different cases. So it's just completely generated. None of this is real. But that's why we can share it, because we just took our experience and made up stuff to demonstrate how a report works. What we actually do is known as investigative due diligence. And the difference between this and a background check is it has a lot on the analysis side rather than being strictly on the, oh, they have a criminal finding, oh, they have a civil finding, things like that. And it's heavier on the context so that you can actually know how something is actually going to affect how you're engaged, not just them in general, but how you're engaging them. Because if you're a lender, for example, and someone has dozens of UCC filings, that's a different risk than if you have a vendor that you're working with and they have dozens of UCC filings. From a vendor risk perspective, that's not a very big thing. But from a lender risk perspective, dozens of UCC filings might indicate that person's over leveraged and you need to be careful as a lender. As if you're looking at them from a vendor perspective, yeah, you might lose out on the vendor, and we might consider the actual cost of acquisition and all of that in there to determine whether or not the engagement's high risk, but it's a lot less than it would be for a lender. So we start out, of course, by telling it's a big, long report. Most of our reports are usually between 40 and 60 pages. We did have a record-breaking one last year on a venture capital company where it was, I believe, 98 pages. But that was mainly driven by the fact that every single one of their founders had a long history in business before. So we go through and make sure you can quickly navigate the report because they're kind of long. One thing that you always want to do, especially, and this isn't just for things like due diligence, it's also in healthcare. You kind of want to tell people what you're doing and why you're doing it so that they understand where you're coming from. I always like to tell people exactly what it is we're doing, how we're doing it, and why we're doing it so that you understand the risk of whatever you're getting involved in and how we actually evaluated that. Because if you don't do that, it's a recipe for confusion. We'll tell you exactly where we went for all the information we pull. And yes, sometimes we will go to that many individual counties because that's one of the difference between a background check and investigative due diligence. Background checks are usually instant or quick, but investigative due diligence, that means I actually went to Maricopa County's, Arizona's website, looked for any lawsuits, went through all their different court levels because a lot of the times these counties have several court levels that you have to search. And then you'll actually go through and make sure that whatever's there is given the proper contextual basis so that you can know how it actually affects the risks of whatever you're getting involved in. We'll also tell you what we didn't search. Usually this is just going to be like professional designations, FINRA. We always search if they were registered with FINRA, but a lot of the times they aren't. You'd be surprised how many times you find someone that the only reason they're out in the private markets is because they were in the public markets and they're not allowed to be there anymore. And this is basically our executive summary. These are the risk ratings that Charlie was talking about earlier. We basically tell you what we found and how that relates to actually what you're trying to engage them for. It's not a general risk rating based on risk rating based on anything. It's actually based on the context that you specifically told us you're engaging them for, which is a lot different than the general risk ratings we use. So we try to make sure that it's actually irrelevant to whatever you are. So in the healthcare space, this is almost always going to be a business partner, an operating partner, someone that we're going to be very heavy. We're heavily going to lean on the regulatory side of things to make sure that they're properly licensed. They're following all the state licensing requirements, because sometimes they have little hiccups where, for example, they have one person on the team that's registered, but the rest of the team is not, which in certain states can get you into trouble. So we actually go in and look up those specific regulations, those specific laws to make sure that it's not going to affect the overall risk of whatever you're engaging them for. Then we go ahead and just give you a quick rundown of what we actually found. This part is more of analyzing the entirety of it. And this part down here is just a summary of all the findings. I'm going to skip through this because this is just our summary for the actual real estate side of things. We do have different risk models based on whatever we're getting involved in. We don't have one for healthcare just yet because what we find a lot of the times is our other models can actually absorb some of the different risks inside of healthcare. So you might see if you're investing in like a healthcare business, we actually do have a private equity model that can cover most of the risks involved there. And we just slightly modify it so that it gets them all. And in healthcare, we also bring in part of this, which is the historical and operational assessment, as well as the track record. Though usually we'll put that down on the individual company level, because otherwise the report gets very long and it doesn't really need to be unless we're looking into a very specific track record. One of the things that is very different between a due diligence investigation and a background check is, of course, you're going to do, your main thing is going to be the person and the companies they operate. So we'll go to the main managing company, whatever that is, and then we'll provide brief summaries. They get their own rating. These are just based on industry norms rather than broader contextual analysis of what you're engaging them for. And then, of course, we do the summaries. And this is another thing that we do that is very important, especially in healthcare, because sometimes people will have multiple LLCs under their names. Essentially, what our web map is, we map out based on registered agents, names, naming conventions, shared addresses, and a dozen other different things that I can't remember right now to figure out any business this person has previously had registered under them. The reason we do this is because sometimes they will move states or they will move industries, and the risk doesn't always disappear. And if you chart that over time, you can kind of get a good idea of who you're dealing with or what kind of business you're dealing with. If you don't, you get a very small snapshot of what they've been doing. For example, if we just did their main managing business, we would not see all these different LLCs. And in a syndication type structures, you would most likely see something like this, where you have multiple property companies, holding companies, different funds, all types of things. And another reason we do stuff like this is to actually, especially if someone's accepting other people's money for a potential investment, is we're also looking for businesses that don't have a good reason to be there. The reason being that sometimes people will take that money and funnel it into different businesses, and they will not tell their investors about that, or they have, in a case we worked last year, we had them register a random business in Florida. For the life of us, we could not figure out what it was for. And then we marked it high risk because of that. And later in the year, they sued the SEC because the SEC was investigating them. And that LLC was brought up as one of the reasons because they were funneling money through it. And we were able to flag that pretty early because of just mapping out all the businesses and making sure, hey, we know this one's operating this. We know this one's operating this. What's this one doing? And if you don't have a good reason for it, a lot of the times it can be a little bit risky. So we look at like the structural nature of everything. And this is important across the board. It can be anything from healthcare to venture capital, even honestly, I don't like saying crypto or digital currency anymore because it is almost always a high risk area now, but it's important across the board to do this because otherwise you miss stuff and it's very easy to miss something big. We will go into different finding categories. This is very important, especially in healthcare, because mostly you won't get criminal findings in healthcare. You will occasionally get some really bad ones, but those are usually easily detectable, and we would probably flag them as high risk before we even started a whole report and just let our client know, hey, yeah, we're already seeing this on the ground. Legal civil findings are probably going to be the biggest thing, that and regulatory findings. So you want to look, especially if there's dispute with residents of a care home or something like that, you want to know exactly what went on, because that can change the situation entirely and how they dealt with it. At the end of the day, you want to, if you're partnering with this person, if you're investing with this person, you want to make sure that person is a good steward of whatever you're giving them. So we'll go through and we'll give you a lot of contextual analysis of what happened. We do this by actually pulling the records directly from the county. So rather than getting a quick summary that just says, hey, they were sued in this place, we'll actually go pull the complaint. We'll go pull the answers. We'll go pull the, if the situation has been resolved, we'll actually tell you how it was resolved. And then we will, of course, go into a lot of detail. These are, honestly, sometimes we have a lot of civil legal findings because not only can people sue you for pretty much anything, you can also get civil fraud in there. So sometimes when you're looking in private markets, you'll get a lot of civil fraud findings, and you have to be really careful with them because they could mean that there's actual fraud occurring. It also could mean that someone lost money and got upset. The context is king there. You want to make sure you know exactly what happened. We'll also go into financial findings. A lot of the times doesn't seem that important in healthcare, but it's actually one of the most important aspects of it. A lot of these, when we see them in healthcare, it's not necessarily the care home itself being ran badly in the financials. It's usually on the operator side. They have a lot of financial issues, which could cause the care home to also have issues, or they could cause their healthcare facility have issues. And you have to be very careful with that because you're sitting in a high regulatory environment. If you suddenly start going, hey, I want to bring in more people because I don't have any money, and you're only authorized to have this many people on hand, now you just broke the law. You didn't just violate a regulatory thing. You broke the law, and you need to be very careful about how financial strain will affect your overall business. And I don't know if anyone's ever told you guys this, but I learned it very quickly when I started my own business. Your personal finances affect your business finances all the time. And that's why we look at it for both the business and the people. And then we do go into UCCs, which they're not a high risk factor in healthcare unless we're looking into lending, but occasionally you can see people doing some weird stuff. We did have one last year. It wasn't on the assisted living space. It was in medical devices.
Ew, no.
It was in medical devices, and they basically across the board had a bunch of UCCs in different states. And they were trying to get investor money into their company as well. But I think the investor money was more like a bailout than anything else, which can be very dangerous because if your business can't support it, you don't really need investor money. Well, to go through those social media, open source, which is just basically anything you can find on the internet. Social media is anything you find on social media. Regulatory findings, this can be incredibly important in healthcare. There are a lot of regulatory agencies, that both state and federal, that get into healthcare, and you want to make sure that they're abiding by all of them if they're required to. And you have to do the research on whether or not you can actually, or you have to do the research on the actual laws and regulations in that area. And then we go into operational findings. And then after that, we'll actually do the individual principles as well. But that's the quick rundown of how the due diligence process works. And you can probably see how it's a very important step in the regulatory process in healthcare. Because if you don't go look for this stuff, a lot of the times you'll get bad business partners, you'll get people that had disclosable risks to you that just weren't disclosed. And you can solve the issues very early on if you know how to spot them, but otherwise you're going to be SOL.
Sorry to interrupt this episode, but let's be honest. Most real estate investing right now, it's either buy a fourplex or try Airbnb and hope for the best.
Yeah, we're not here for that.
We're here to show you what we believe is the most overlooked high cash flow real estate strategy in the game right now. You guessed it, residential assisted living. It's literally the one place in real estate where you can net six figures on a single home and feel like a decent human being at the same time. You're helping sweet old ladies eat pancakes and play bingo and live longer through better care. You tell me what's better than that.
So we're hosting a free live webinar called How You Can Create Financial Freedom with Residential Assisted Living. No fluff, just value. And it's happening at 8:30 p.m. Eastern Time, 6:30 Mountain Time. No excuses. It's online. Put on sweatpants. We won't judge.
We'll break down why residential assisted living is the best opportunity right now, the 5 steps to take down your first home, and how to set up a business that makes a real impact and real money.
Spots are limited, so don't be that person who DMs us in 3 months saying, wait, is it too late to start?
So hit up therowroom.com/webinar and register now.
Be the hero your grandma already thinks that you are.
We'll see you there. Pancakes not included.
Thanks, Shane. I wanted to
Are we good to open it up for questions then?
Oh, absolutely. I was about to start asking my question.
Okay.
Yeah. Does
Yeah.
anyone have any questions?
Whoever's got them, fire away. I'd highly recommend doing this for anybody that you plan to invest with or partner with. The cost to benefit ratio is out of this world.
I want to add an endorsement here if I can. So we use Shane on Everwood Reserve for many different purposes. We researched even the seller of the land. We researched our GC. We did a background check on ourselves, every single person that was partnering with us. And not only did that help us in all the ways Shane outlined in his reports, feel more comfortable about what we were doing, but it also really helped investors. And and the bank, right? We were able to basically provide all this information that says, hey, everyone on this project that's involved, from the sponsors down to the people that are executing the work, have been vetted, they've been cleared, they've been researched at a deeper level. And that inspires confidence in the bank. And it also inspires confidence in investors. So I do think there are just so many different dimensions to the way that these types of reports can help. And like Charlie said, the ROI compared to the price is pretty extraordinary. Yeah, just want to say it was an incredibly useful resource for us with Everwood Reserve.
It depends on if the license administrator was responsible for any. We could do a check on an individual, but a lot of the times what we see is that if they're not running the business or they're not financially responsible for it, a lot of the times a basic background check actually covers everything you need. So if it was a licensed company that you were working with that you were thinking about bringing on as a business partner, that would be a different thing. But if it's just a single person that you're working with and you don't really have any reason to believe that they're funneling money out of your organization or anything like that, I would say for a licensed administrator, it probably wouldn't be a great return on investment there.
Thank you. And what's one of the craziest things you've seen come back?
Ooh,
Let's get some story or two.
I've had some pretty crazy ones because I've been doing due diligence for over 6 years now, 7 years, somewhere around there. One of the craziest ones we found from last year was there was a founder that we were working in the venture capital space. There was a founder that raised a funding round, like a very initial funding round, and then immediately went off and bought a Lamborghini and then posted it all over social media. And then when they realized that people were watching that, because our client was like, yeah, we didn't use you on this, but because it was before we started working with you, but we wanted you to look into it now because we saw all these pictures of a Lamborghini and then suddenly they disappeared. And then we looked onto the founders. It was either his wife or his girlfriend. We couldn't really find the marriage certificate, so we weren't absolutely sure, but all the photos were still up on her side. So we pulled those in, made documents of all of them, and we were like, yeah, you definitely need to go we actually work with a bunch of different companies, especially in the due diligence space. So we sent them to our financial due diligence partner who tracks the actual money flow out of the person's bank so that like on a daily basis, hey, this is how much money they spent on this. This is pretty industry norms, or this is a red flag, things like that. So you can track the money flows, which we do a little bit, but we do it more from a public record side. And once you've already invested money in them, it makes more sense to do something like that.
That's pretty funny. That's not what I expected.
Yeah, there are some pretty crazy stories. We did have a real estate syndicator that did something similar. He bought a beach house, had horrible finances on everything else. He would have huge loan to values that just didn't make any sense for the properties he was buying. And then he actually bought a beach house, and that was really the only thing he paid real cash for. So I was looking at that, and then we looked at a personal home he purchased, and that was another thing that he actually spent real cash on. So we were like, okay, so the beach house and your personal home got real cash, but all your investment properties are hugely over leveraged. That's probably not a great look. Even just from a financials perspective, if he was planning on renting out the beach house for rental income or something like that. It didn't really make a lot of sense. Never really does. Beach houses aren't really a great rental investment for a real estate syndication company, and that was not how they advertised themselves. We're going to go buy beach houses. They were pretty much a very middle of the line. Oh, we're going to buy apartments, have conservative finances, and do multifamily apartments. That's not what they were doing.
Also wild.
You got to have somewhere to drive your Ferrari to.
That's right.
Oh, yeah.
Yeah.
Yeah, I spend way too much time on people's social media looking at, especially for the guru type people, looking at what kind of car they're driving, where they're living, why there's an LLC that owns a single family home that has nothing to do with the syndication business, is seeing, hey, is this part of their old real estate structure? Because a lot of these guys, they actually did have single family homes before they got into real estate syndications. But if they're living in that home and then the syndication company is funneling money into it, it suddenly becomes a bigger problem. Or if in one case, the syndication did a loan to an LLC that owned the single family home of the syndicator themselves. So a little bit crazy. And that's the kind of stuff you don't really see in the headlines, especially in The Real Deal and places like that. They like to focus on the companies that lost money. And from our perspective, a lot of the times the guys that lost money are actually less of red flags, as long as it's not systemic, it's not across their portfolio, they're just constantly taking a bath on all their things. If it's one or two deals, normally that means that they're just hitting market conditions. If it's a dozen deals, that's a problem. If they seem to be doing fine on the surface, but they've only been in it for 2 years and you can't really tell if the deals are doing well, that's also an issue. We actually get nerdy with it. I call it the Kobayashi Maru private markets, because we try to make sure that they've actually been tested. And if they haven't been tested, it's a risk for everyone involved.
Yeah, that makes sense. What advice would you have for, let's say, one of our members are doing a bigger project right off the bat? They don't have a lot of track record investors. Do you have anything you would say to someone like that?
Yes. One, do it right. I think Aaron's a great example of doing it right. The first time when we started working together, he was constantly asking me questions about how things were going to work, how transparent he should be with certain things, thinking about long-term what partners to bring on to make the project successful. And these weren't people that were like, oh, this is also my first deal. These were people that actually had experience, right down to the people that are building Everwood Reserve. So we're from across the board, it's a different perspective when you're doing it right. Got my words all mixed up. When you're doing it right versus when you're just trying to do something. And it just comes down to being realistic on how you're going to take other people's money, how you're going to put it back into your project, and how you're going to actually deliver value with that project. And that you're going to be transparent the whole time you're doing that. Because if you're not, then you're going to get into a little bit of trouble.
Good advice. Do it right the first time.
Yep. Actually, we just got a new partner in the venture capital space, and that's exactly the theme of our whole engagement. Is we're actually working directly with founders on doing things right the first time so that they can actually build their business properly, rather than rely on, we're just going to pull in a whole bunch of capital and hope things work out.
With a slide that just says no Lamborghinis or what?
Need to part with it. That's definitely part of it. It's mostly don't make any big expenses for the first 5 years when you're building the company up, because someone's going to look at that and they're going to be like, especially institutionally, some of these guys have programs that can very quickly pull in property record data. Some of them can even pull in vehicle data now, and they'll flag it. They'll go, hey, he's got this sports car. When did he get it? How long has he had it? How much is it worth? Where did the money come from? Because sometimes you have repeat founders, and obviously you can go and say, oh, okay, yeah, he had money before he started this company. He's not taking investor funds for this. He's owned a $5 million house for 20 plus years. That's not the same guy. But then you get those other guys who they're young, they want to project success, so they start buying all kinds of crazy things to try to do that. And one time, actually, we had a founder who rented a Lamborghini and wanted to be very clear that's what happened, because he was like, yeah, I was trying to project success, but I knew I shouldn't buy a Lamborghini because that would be dumb. And then he was like, yeah, so I rented this. And then he provided the venture capital company we were working with on the receipt from the rental, how much it cost, how much he thinks it returned on an investment. And it did definitely turn the situation into a better thing than, oh, he bought a Lamborghini. That's bad. It turned into, okay, so maybe we need to talk to him about financial management a little bit.
So I guess private jets are out.
Oh, yeah. I've only had one private jet so far. They're
Damn
too
it.
expensive.
But why?
I mean, you get great ROI on those plane tickets too, especially if you're closing deals with them.
Guys, just to be clear, the Brow Room can only afford the Little Tykes private jet that goes back here. Okay? Private jet in the future.
Yeah.
So
Actually,
more questions. Oh, go ahead, Shane. Sorry.
I do know guys that can afford private jets, and he's driving across the country right now instead. So it's a different mindset. He was like, yeah, we can get the private jet. Or he was like, I just decided to drive. It's nice to drive sometimes. I'm like, okay. So I'm getting very sporadic calls from him. Today I'm in Miami. I'm like, how long have you been driving? Today I'm in Oregon. I'm like, you were in Miami 3 days ago. How long did you drive? So it's a very different mindset when you're actually building wealth rather than just trying to spend it.
All right, guys, who's got a question for the expert on investigating people, doing due diligence?
I had to drop for a second, so maybe this was already answered. Feel free to shut down if so. But what if we flip the frame and say we, as operators of very complex businesses that have lots of different types of liability, what are some things that we can do other than behave with integrity to maintain a clean record through all the different lenses that you typically evaluate?
One of the really big things that you can do is what you already said, behave with integrity. And the second you start taking other people's money, don't just do integrity, do transparency too. People need to know how things are going. That's why when you invest in like Apple or something, Apple's a very transparent company, believe it or not. You can look through everything they're dealing with if you have the time. And they'll tell you about it too, because they're legally required to. But you can look on 500 pages of what Apple's up to. And they get in a lot of trouble if that's not accurate. So you get a securities fraud lawsuit. So you want to be transparent in the private markets. That's going to do 90% of it. I always tell people it's private markets. It's not rose-colored glasses. At some point, you're going to lose money. It's going to suck. And that's the risk you signed up for too, because there's plenty of ways where you can just go make a little bit of money. You can go into the stock market. Most of the time that goes up and down, but like over time, it usually just goes up. You can go government bonds and stuff and get pretty good returns. But the reason people go into private market is because the returns are higher and you're being paid to take that risk. So one of the real big things you can do is, of course, work with someone like me to go do due diligence on your own company and see where you might be lacking. If you're not already lacking, a lot of the times, part of that's going to come back clean, and then the rest is going to be potential issues in the future. For example, if you're working in a highly regulated space like healthcare, a lot of it's going to be focused on how companies like yours actually work in healthcare and how they keep compliant. And how they keep, one of the worst ones I've seen is a person that vastly underestimated how expensive a good caretaker was. And they were like, oh, we're going to pay $55,000 a year for our caretaker. And that was it. They were like, that's about their salary. I'm like, what about their health care? What about potential overtime pay? You're saying you're going to have this one caretaker for this whole, and I think it was a six bed facility. So it wasn't completely out of the question, but it was one of those things where you're like, you need to pay more than that because you're going to get you pay for quality. So even if you up that by 5,000 and then paid for insurance and all that stuff to make sure they were comfortable and that they're focused on your residents' care, it changes the game a lot. Because if you try to hire from the bottom tier of the pool, you're going to get people that only work at that bottom tier, which that's not a derogatory statement. It's just kind of how it works. And if you keep doing that over time, it's going to be more expensive for you long run because you're going to start getting violations. You might even get a lawsuit if they don't know how to deal with residents' family members because they want to be rude or they're tired and overworked and they just can't really deal with public facing roles as well as doing all their other duties, which that's completely understandable. But also you don't want that to happen to you if you're running a business.
So you bring up a good point, and it's something I've noticed when looking at your reports, which is that there's reputational risk and there's like behaviors that you observe, and then there's legal or civil, or there's actual like documented litigation and things that you can find on people, and they carry different types of risk. So I don't know if you can click into a little bit like what types of weighting, because a bad reputation can be just as hard to overcome as, and frankly, more like directly impactful to a business in the immediate sense as like a 7-year-old lawsuit that was settled with no adverse effects on the party, right? So like, how do you think of those different things and weight them in your risk ratings?
It's actually really complex, but it actually does come back to those structured findings. So let's say this is actually really relevant right now. Let's say you have a real estate syndicator. They just lost a deal. A lot of people lost money and a lot of people are mad. What's going to happen there is all these people are going to write about it on social media. They're going to talk about it on LinkedIn. They're going to talk about it on Invest Clearly, all those websites, Bigger Pockets. They're going to be talking about it everywhere, which is fine. That's actually really great. It's a big part of the process. That's part of transparency. The initial thing is going to be a bloodbath. They're going to be strung through the mud. But what we actually do is if there's a finding like that, we tie it back to their actual operations. So we're looking at their whole portfolio and going, okay, they lost 2 properties or 3 properties out of a 64 portfolio property. How are those other 61 properties doing? And when you look at that and you go through, okay, there's a couple that are struggling, but it doesn't seem like the same thing's occurring there. There are a lot doing well, and then some are doing okay. And we go up and we go, okay, so overall, the portfolio is still pretty solid. So rather than go, hey, this is a high risk factor because people have lost their money, it might go down to a medium. It probably would not go down to a low risk factor just because we work with a lot of individual investors and a lot of our evaluations are done from their perspective. So I have to go, hey, how did they structure this deal? And a lot of the times when we're seeing that, we actually see the deals that go really bad are the ones that they got in with bad partners on. For example, one of the big real estate deals that went down recently, we flagged the partner on that deal it was back when I first started the company, so over 2 years ago at this point. Because one of our initial clients wanted to go into one of their deals, and I'm like, hey, this is going to be high risk because of these factors. And not a lot of due diligence was done on that partner. They got into a big deal with someone else, and then suddenly it becomes a huge issue because due diligence wasn't done on the partner.
Curious for anybody else in the room, like prior to being exposed to Shane and hearing us talk about this service, is this something that came natural to you guys as, hey, we need to dig deeper into partners, deeper into the people that we're working with, even sometimes like your biggest investors? Because this was a big breakthrough for me when I was first introduced to Shane.
The biggest investors are one of the ones that people a little bit, they sleep on that one because it can be a risk, but it's not done nearly enough, especially in private markets, to look at your investors themselves.
Yeah, I'll say I didn't know this kind of service really existed until we met Shane, and didn't think much about how that would have been nice to do many times over in my past. And I know personally I wouldn't go without it in the future.
Yeah, I'm sorry I got on a little bit late, Shane. Just from what I'm gathering, you're an investigator of people. And
Yeah, no, you know what? I think you missed the big presentation part,
that's
but
okay.
no problem. What we actually reviewed is, if you look me up on LinkedIn, what we reviewed there is it's just one of our demo reports, and it's freely available to everyone. Basically, anytime aren't you afraid of putting your reports out there so people can replicate them? I'm like, you can try, but it's going to be very expensive for you.
Yeah, I'm all about investigating or looking into people and understanding who they are. So if that's your service, I'll definitely be using it.
Yes, we're also on the kind of analysis side, where we look into not just the person themselves, but the markets, how certain risks are going to affect them long term. We also look at their wider portfolio of businesses to make sure that if they're behaving a certain way in one business, usually it carries across. I think the worst case we ever had was a person that carried over $5 million in debt from all of their different businesses. And it wasn't like debt from UCCs or anything like that, like structured debt. It was judgments from things that they'd done bad. And I know we only got 15 minutes, but I can run through part of the report for Mike if he'd like, because I'm sure a couple other people might have missed parts of it. I'm pretty sure I can do it in 15 minutes. Is that something you guys would be interested in?
Sure. You like
I'm at, and that, right.
I had to check my time. Usually my schedule is kind of jam-packed these days, but today I actually had only one meeting because I was kind of happy with that. Yesterday I was running between meetings, literally running, like, luckily it was like 5 minutes because I was like, and all my meetings are virtual. So I was like running between here and the bathroom or trying to get something to eat. But so this is one of our
If you had
one
that
of our
Ferrari, you
reports.
could go faster.
This is one of our reports. What we do is known as investigative due diligence. It's a very important distinction between a background check, because background checks don't really check for contextual analysis or anything like that. They just give you basic information. Of course, it's a pretty long report. Usually our reports average in like 40 to 60 pages. So of course we have to do a table of contents so that you don't get lost in there. We always tell you what we actually do, what we went through, how we do that, and how we verify information. We also tell you where we went to verify that information. And we also tell you what we didn't do, because usually we're looking for, even if someone is not registered with FINRA currently, we still look, because a lot of the times there are people that are not allowed to be in public markets anymore that go to private markets to try to get something over, and then they run into the foul of, you're still working in securities. So this is one of our big things. We do basically a executive summary of what we found and contextualize it to whatever you're doing. So this part is, we line out all the risks from the company and the partners, and we tell you how that relates to what you're doing. We summarize whatever findings are in the whole report so that you don't have to look through the whole report every single time. This report's actually based in real estate syndications. So I'm going to scroll over this a little bit, but essentially all we're doing here is going through their operations, their track record, the individual property, going down to the property record levels, pulling assessor records, things like that, to make sure if they say, hey, we invested in this apartment complex and it's going really well, that the reality on the ground is actually that. And that assessment goes on forever, but then we'll go into the actual business itself. So we start out with whatever the main managing LLC is. We'll provide some summaries of their information, make sure that they're actively registered as a business and that they're not doing anything funny with their regulatory requirements. And then we'll actually do a separate rating just for that business and any businesses under its umbrella. So we'll make sure you know exactly where the risk is coming from, rather than go, oh, okay, the risk is from the business or the risk is from the person, and then just not telling you which one it's coming from. Everything's summarized. This is something different we do. We actually build out what we call our web map. So we link up different businesses based on registered address, naming conventions, registered agents, shared principals, and we put that all into our report. The reason being, if we don't do something like this, where we're mapping out all these entities and making sure they're all compliant and making sure they're all doing what they're supposed to be, we can miss things like money moving to different companies that don't have a verified purpose. We can miss companies that have lots of liens or judgments under them that are not even part of any of the investor materials. And it just gives us a better picture of risk if we do it this way, rather than go and say, hey, we're just going to look at that one managing company. The managing company might not even be the one they take out debt through. So we look through and contextualize everything, make sure you get some notes and what we're seeing on their entity structure, because there are proper ways to structure entities and improper ways. Sometimes we see some really crazy structures and we have to ask someone about them, and we're like, this is not something that's very average. And we want to put that in as a risk, because having overly complex entity formation is a risk. We'll go through legal criminal findings. Those aren't very common, but sometimes we do get some nasty ones in there. We'll go to civil findings. This is where we get most of our findings, but we like to go into very specific detail on what's actually happening, because otherwise you can't actually gauge the risk of what's going on there. For example, we'll usually tell you where a lawsuit was filed, what entity was filed against, what actually happened, and then what the resolution was if there was a resolution. That way you know exactly what it is. And then we contextualize all that later in the executive summaries. So we'll go through, do any civil findings that we find, we'll put in here. If they have 150 lawsuits or something, which is something that's actually happened before, we won't list out every 151. We will just tell you what they were about and what the contextual thing is, and we'll pull out the worst ones and be like, hey, these are the ones with high judgments amounts. These are the ones where they were accused of something really bad. And then for the rest, we'll just summarize them in general about what they were, because of course in apartment syndications, sometimes they get sued by tenants a lot, or they sue tenants and there's a bunch of evictions. So if we listed out every single one as an individual finding, it would take quite a while. We'll go through civil findings, and that goes on for quite a while, but then we'll actually go into their financials. We'll make sure if they have any liens, judgments, bankruptcies, if they have loan modifications, UCC filings, even things like, for example, if you're investing in a company and their distributions start suspending and they reduce cash flow, and cash flow starts to seem like it's getting crunched, we actually put that as a finding so that you know about it. These are just UCCs. We'll always list those out, because we do work with lenders as well. So occasionally we'll see just like a completely over leveraged portfolio, which carries a different risk for a lender, but it also does carry risk for an LP. We go through social media, open source media, which is just anything else out there. And then we will, of course, do regulatory findings, operational findings, and that's actually all the finding categories we have. And then we'll actually go into individual principles, which is a little bit different, but we contextualize that as like, we go through the company, the people, and then what if this guy, for example, had any companies that were specifically registered to him that were not related to this company he's working on right now, we would actually put that under his summary so that we could show how he's working across his business ventures. Are entities registered in Wyoming and Nevada higher risk? Not necessarily. Every company, it used to be Delaware, where people would always register their companies in Delaware, but people started moving to Wyoming, and then just recently, in the last couple of years, it's tax reasons, really. So it's not necessarily bad. A lot of the times we find them pretty easily. The structure's not weird. What I would say is that if they suddenly jump between all three of those states, that can be a risk. So if they had a Delaware finding, then they moved to Wyoming, and then they moved to Nevada, I'm going to have questions about that. But if they had an old business entity registered in Delaware And then over time, they moved it to Wyoming. And then in the last couple of years, they've moved it to Nevada. And there's no real, like, it doesn't seem like they canceled one and then immediately started the other. That's not a big a deal, because the main reason to do that is, of course, tax reasons, and in some cases, legal shielding. But honestly, that whole philosophy has taken a hit in recent years. So it can be, especially if you think it's going to shield you from being fraudulent or scammy and things like that. If you were a bad actor, they're going to come after you through your LLC regardless. There's not a lot of ways for you to protect yourself for being a bad actor. That pretty much shoots out any protections you would be given.
Very good.
Are you guys able to provide these services offshore?
It depends. We do a lot of work in venture capital, so sometimes these companies will be in Germany or other places, and we can do it on a limited basis. But I always tell you beforehand, I'm going to go check what our access is there to make sure we have all the information we need. Right off the bat, I will tell you that access is growing globally. It's being easier and easier to access information. The only one that I still say absolutely not, I'm not even going to try, is China, places like that where their information security is very high, and you have to be a Chinese citizen to basically get anything out of them. I'm like, there's companies that specialize in those specific areas. I'll just go look at those for you, and we'll figure out a good one together.
Thanks for going over that for me.
Yeah, see, Mike just wants to get his Lamborghini in China so he can avoid the law.
No, just true story. I had a friend that just shared with me yesterday that there was she's working on some capital stack, and some of the funding was coming from, I forget, somewhere in Europe. I can't remember exactly where. And it was a scam. It was just like, it seemed legit, took them through the whole process and got to the very end of the process. And it was like, hey, we need you to pay this much money up front. So basically, yeah. And then she found out when she didn't go through it, she reached out to some friends, and her friends were like, oh man, we're so glad you didn't do that. We all got taken by that. There are 3 other people she knew that got taken by it. So, yeah.
And that's one of the really big things in fraud is people don't like talking about it. They don't like saying, like, right out, oh yeah, I got defrauded by this guy. It's partially because they're worried about defamation, but honestly, if you can just say the fact, and that's not defamation. If you go, hey, I wired this money and then never got anything.
Yeah.
That's not calling them a fraud. You can say that.
Yeah.
But Europe's definitely one of the ones that we have a lot of access in, which is weird because there's a bunch of different languages, but a lot of the times you can pressure them to give you English documentation because they have it on hand.
Yeah.
Oh, I just want to say hi, Shane. I think this is the first time that we jumped on a call together. For those of you who don't know, I actually retained Shane's service. We haven't done a report yet, but I'm sure at some point we will. So just thought to make that investment up front.
Smart man.
I'll discount license.
Yeah, hi, Richard. Yeah, no, I think it's the first time we jumped on a call. I always put it at the end of the email, but people are busy, so they don't always get a chance to jump on one.
Shane, can we get your contact information? I haven't seen it yet. It may be on here.
Yeah, it's actually, I'll just put it in the chat for you guys real quick, but wait, hold on. That was my personal email. You'll get lost in that one.
That's on me, guys. I'm going to add him to the new resources module we're building out. So he'll have his own little section in there and contact info there as well.
And then you can also just look me at, let me pull out my link real quick. But you can also look me up on LinkedIn. That's where I do that's where I get in touch with a lot of people. I'm always on webinars, podcasts, all kinds of things. Just basically telling people exactly this because it's something that institutional investors use all the time to lower the risk of being out in the private markets. And it's not something that people just get to do anymore. It's not something that people can access easily.
But you're making it accessible for us, and we appreciate that. Thank you, Shane. Thank you for your time, man. It's always fun having you on. It's always insightful, and I hope that people really understand how important it is to do this. Don't make the mistake of not doing a report is my biggest takeaway. Any parting shots from anyone before we hop off? All right. Thanks again, Shane. Really appreciate you. Stay busy, but not too busy that you can't help our members.
No problem. Thanks for having me on.
All right, buddy. We'll see ya.
Yeah.
Bye, everyone.
Thank you for tuning in to the Ral Room Assisted Living Podcast. We hope you found today's episode insightful. If you enjoyed it, make sure to leave us a raving 5-star review. And a quick review helps more listeners find the show and more seniors get the exceptional care they deserve.
And don't forget to subscribe so you never miss an episode. And just so you know, we have prepared some free resources for you to help you succeed in residential assisted living in addition to this podcast. Head over to theralroom.com, that is theralroom.com, to download our free 10-step guide to launch your first or next residential assisted living home, or our 10 reasons to passively invest in residential assisted living ebooks.
And if you're ready to take the next step and make real moves in the RAL industry, join us in the Ral Room Mastermind. It is an exclusive community where we deep dive into everything you need to launch and grow your own residential assisted living business. You'll get access to recorded courses, live calls with industry experts, a RAL calculator, resources and tools, like-minded entrepreneurs, funding opportunities, and an expert networking community to help you along your journey.
Be sure to join us next time on the Ral Room Podcast as we continue to explore the world of residential assisted living with more great guests. See you then.